Hey, this is Chris, and in this short video I'm going to be talking about dividend reinvestment plans, or DRPs, and how they work for ETFs. Now, I think a lot of investors that have invested in bank shares, in Telstra and Woolworths and BHP will be used to the option to reinvest your dividends. Often when you get your dividend each year, the company will give you the opportunity to buy shares either at the current market price or sometimes at a small discount. And so you don't have to go and pay brokerage and buy more shares. And if you don't need that income for your life, it's a great way of building compound growth over time. And we often get asked by our clients, can I opt in for a similar sort of structure with my ETFs so that when all of the dividends of the underlying companies within the ETF are paid out, and for a lot of the ETFs that we invest in at Stockspot, that's either quarterly or half yearly, whether that can be automatically just reinvested back into the ETF. And in most cases, it is possible. So most ETFs in Australia do offer the option to reinvest back into that ETF. It can be a fantastic option for people because it helps to avoid the cost of brokerage, which particularly for smaller dividend amounts might eat into a lot of your potential returns, but then also allows you to really set up a great long-term savings scheme, recycling all of the earnings you're getting back into those companies to get the fantastic impact of long-term growth. However, we actually don't offer it at Stockspot for a particular reason, and that is that the biggest dividend paying ETF in our portfolios is the Australian shares ETF. Historically, shares in Australia have paid higher dividends than global shares, emerging market shares, even government bonds, and particularly gold that doesn't pay a dividend. So what you would see over time if you participated in DRPs for an ETF portfolio is that all of the dividends are coming from a particular ETF and getting reinvested back into that ETF, and therefore you'd see the Australian share component of your portfolio getting bigger and bigger and bigger over time. That actually means you'd be taking more and more risk in that part of your portfolio. So rather than investing back into the same ETF that the dividends came from, we actually take our clients' dividends and reinvest it into whatever asset is most underweight in your portfolio. Now that might be the Australian shares ETF, but it might be a different one, like the global shares ETF, emerging markets, gold, or bonds. And the benefit of this process is that you keep your portfolio balanced over time. You're not taking too much risk somewhere. And for our clients at least, we're not charging brokerage anyway, so it doesn't really matter. You're not avoiding any cost, and you're still getting the benefit of reinvesting that money and earning the compound growth. So in summary, DRPs are available for a lot of ETFs. Great option for people that aren't needing the income today, but also you should be considering whether you should be investing back into that same ETF or actually taking the dividend and using it as an opportunity to rebalance your portfolio, which is what we do for our clients at Stockspot.